You ever get the feeling that Forex trading is less about, actual trading and more about getting, like, completely swept away by a tsunami of conflicting advice? Yeah, tell me about it. It can be overwhelming out there. But fear not, fellow traders, because on this deep dive, we're going deep, deep undercover, ditching the noise, and tuning into, well, what I like to call the whispers of the real asterisk market movers, those institutional traders.
Right, right.
We're cracking the code, folks, and to help us with this little heist, we're diving deep into some exclusive training material from, drumroll please, the Inner Circle Trader.
Ooh, yeah, he's the real deal.
Oh, he claims to be. This guy supposedly has cracked the code of how these big institutions think and trade. So are you ready to think like the big players?
Born ready, let's do it.
Let's go.
All right, so here's the thing, right? Most retail traders, they're taught to look for patterns, using indicators, you know the drill, trying to predict where the market's going next.
Yeah, classic rookie mistake. I've been there.
But for a second, just imagine you're an institution with millions, billions even, to move. You don't need to predict the market. You can actually influence it.
Okay, well, hold on. So instead of being the little guy trying to outsmart everyone, you're saying we need to start thinking like the market makers.
Exactly. And the key to that is understanding this thing called order flow.
Order flow, okay.
Essentially, it's about tracking where the big, and I mean big, money is flowing in and out of the market. Institutions aren't relying on fancy indicators. They're looking at the raw price action.
Raw price action, you mean just the...
The open, the high, low, and the close of each candle.
Hold on, you're saying forget all the complicated stuff and just focus on those four basic price points? I mean, it sounds almost asterisk simple.
See, that's the thing. Retail traders are often conditioned to believe that Forex is this big, scary, overly complex beast.
Right, yeah.
But at its core, it's actually all about supply and demand. Institutions know this, and they know how to use those simple price points to their advantage.
All right. You've definitely piqued my curiosity. So if we ditch the indicators, the fancy algorithms, all that, how do we start deciphering what the institutions are actually doing? How do we read those whispers you mentioned?
Well, you got to know what to look for.
Yeah.
It's all about the subtle cues. And one of the most telling signs, believe it or not, is a pattern you probably know well, the double top and bottom.
The double top and bottom. Really? Now, double tops and bottoms, those are those candlestick patterns that look like, well, two tops or bottoms, right? I mean, they seem pretty basic.
Yeah, visually, they are simple. You're right. But they can be like flashing neon signs for these institutional traders. See, those patterns often represent price levels where, get this, a lot of retail traders have set their stop-loss orders.
Ah, okay. Makes sense, right? You hit that second top or bottom, and boom, people panic thinking the trend is reversing.
Precisely. And you know who else knows this? The institutions. They can practically see these clusters of stop-loss orders just sitting there like sitting ducks.
Brutal. So they just swoop in.
Oh, it's worse than that.
Yeah.
Sometimes they'll intentionally drive the price down just to raid those stops. It's wild.
No way. So they're manipulating the market.
Well, not manipulating, but definitely exploiting it. See, when they trigger those stops, it creates a cascade of sell orders, which creates even more asterisk downward momentum.
So they're not just riding the wave, they're actually helping to create it by, like, exploiting these predictable patterns.
Exactly. In fact, the source, he gives an example of this playing out on the EURDSD 15-minute chart.
Okay, so let's break this down then.
All right, so imagine you're looking at it, right? You see this double bottom forming.
Okay, I'm picturing it. What happens next?
So the trader in the example, he identifies this pattern.
Right.
And he recognizes the high probability that stop-loss orders are clustered just below those recent lows.
Makes sense. So then what does he do?
He waits. He waits for signs that institutions are starting to push the price down towards that level.
Ah, so they're not trying to time the market perfectly. They're waiting for confirmation that the institutions are already making their move.
Exactly. It's about understanding the forces at play, not trying to outguess them. And once that price drops, boom, those stop losses are triggered. And here's the thing, it often creates a ripple effect. More sellers jump in, driving the price down even further.
Wow, it's like a self-fulfilling prophecy, but driven by these institutional players.
It is. And this is where things get even more asterisk interesting. The Inner Circle trader goes on to explain his strategies for not only identifying these setups, but also for timing your entries and exits to maximize profits. He calls it the, get this, ICT optimal trade entry, and he uses something you might not expect.
Okay, hit me. What is it?
Fibonacci retracements.
Wait, Fibonacci. I thought we were ditching all those complex indicators.
We are. But remember, Fibonacci retracements aren't some mystical tool, okay? They're simply a way to identify potential levels of support and resistance in the market. And guess what? Institutions use them too.
So it's not about the indicator itself. It's about understanding how the people with the asterisk, big asterisk money are using it.
That's the key takeaway here.
Yeah.
The ICT optimal trade entry specifically focuses on the 60–70% retracement levels within a move.
Okay, I'm still picturing that Euro USD chart, right? We've got our double bottom. We see the institutions driving the price down. Are you saying they wait for the price to bounce back, asterisk, up asterisk to that 62–70% level asterisk before asterisk entering the trade?
You're catching on quickly. That's precisely it. It's like waiting for the perfect moment to jump on a moving train. You don't want to be too early, and you definitely don't want to be too late.
And this 62–70% retracement zone, that's like the sweet spot, the ideal entry point,
That's because it often represents a point where that initial selling pressure has subsided, right?
Yeah.
And institutions might be looking to accumulate more of the asset at a discount. It's all about supply and demand, remember?
This is, wow, it's really something. So instead of chasing after the market, we're learning to anticipate where it's going based on how institutions operate.
Precisely. Now, along with this optimal entry, the source also introduces this concept of bearish or bullish ICT order blocks. Think of these as like footprints left behind by institutional traders. They're specific candlestick patterns that signal a high concentration of buying or selling activity.
Okay, so we're looking for these footprints to guide our trades. Tell me more. So we're looking for these footprints to like guide our trades. I'm intrigued. Tell me more.
Yeah, it's pretty wild, right? These order blocks, they act like magnets, basically. They have this way of pulling the price back to them.
Okay.
So the strategy here, with the inner circle trader is saying, is you got to wait for the market to retrace back to these order blocks. And when it does, bam, that's your entry point, potentially a low-risk one at that.
It's like we're, what, following the institutional breadcrumbs and they're leading us to, potential profit. I like it. But this all sounds incredibly precise. Like, how can we be sure we're identifying these order blocks correctly?
Well, that's the thing about this source. He really goes into detail. Like, he provides visual examples,
Yeah.
walks you through specific trade setups. It's all there. In fact, there's this really compelling example using, you guessed it, the Euro AD chart again.
Oh, I am here for a good case study. Let's hear it.
Okay, so picture this, right? The trader, he identifies a bearish order block. Remember that cluster of selling activity at a specific price level.
Right, right.
And then they wait patiently for the market to retrace up to that level.
Okay, so again, no chasing the trade, waiting for that setup to come to them.
Exactly. And once that price hits that bearish order block, bam, acting like a ceiling, the trader enters a short position. They're anticipating the price to drop.
Because they're essentially riding the coattails of those initial institutional sell orders that created the order block in the first place, right?
You got it. And here's the best part. It's not just about entry points, right? The source, he really stresses having a well-defined exit strategy too.
Which, let's be honest, that's where a lot of us go wrong.
Yeah. He actually talks about like aiming for 20 to 30 pips of profit per week, which is reasonable then, right? And let's face it, pretty appealing for most traders.
Absolutely. It's about consistency, managing risk, not just, swinging for the fences every single time, which, now that I mention it, was another key point this guy emphasized.
Oh, yeah. Even with all this talk about like institutional strategies and all that, he's very clear. Risk management is king. In fact, he shows how the trader in this example, they use a super tight stop loss order, placed just above that entry point, minimizing those potential losses if if it goes south.
So even though we're learning to think like the big players, we still got played smart ourselves. No gambling here.
Exactly. Because, hey, even institutions, they get it wrong sometimes. The thing that separates, the pros from the amateurs, it's that unwavering commitment to managing risk.
So true. This deep dive, I gotta say, real eye-opener. We went from feeling honestly kind of overwhelmed by all the chaos of the Forex market to uncovering these hidden patterns, these strategies that institutions use to, to their advantage. It's fascinating, isn't it?
It is. And the even better news is these strategies, they're accessible to anyone, really, who's willing to put in the time, the effort to learn them. It's like we've unlocked this, secret language of the market.
It's empowering, isn't it? Knowing that we don't just have to be swept away by all the noise, but we can actually learn to read the subtle cues, the whispers, if you will, of the market, and make smarter trading decisions because of it.
Exactly. And here's something else to think about, If institutions are using these strategies, what other subtle patterns, behaviors maybe, Are they leveraging that, well, that we haven't even touched on today?
Now, that asterisk is a thought to ponder, folks. So to our listeners, if you're ready to, ditch those unreliable indicators and start thinking like an institutional trader, remember, it's all about understanding that order flow, identifying those telltale patterns like double tops and bottoms, those order blocks, and always, always, always manage your risk. Until next time, happy trading, everyone.